In this video, I'll be giving you a brief introduction to M&A strategy. This is going to be a masterclass for you to understand where you might want to go when you want to go out and acquire businesses. Mergers and acquisitions is a strategy to go out there and purchase and acquire other businesses, product lines, assets to increase your wealth and your income, to improve your business through value creation. Before you get started in mergers and acquisitions, you really need to understand what your goal is. Is your primary goal to build an empire, what I call empire, or exit? Yeah? So this is your first decision that you need to make. And of course, this can change over time. It doesn't mean that, for example, if you started out to say, right, I'm going to go out and I'm going to build something for exit, that you can't change your mind midway through your M&A journey and say, right, in fact, I'm going to build an empire instead of going out to exit, or vice versa. So what do I mean by empire? Exit is pretty straightforward. Empire, basically, I have coined that phrase to mean income. So when you go out and you choose to go and acquire businesses, you're going to be thinking to yourself, do I want to increase my income, or are you going out there to exit one day and to create wealth, right? Now, if you build enough income, then you create wealth as well. And if you build enough enterprise value, let's use that term here, exit is derived, or value of an exit is derived from enterprise value. If you can increase enterprise value, that's when you can achieve a good exit. So enterprise value is derived from multiple factors, and we're not going to go into that today. So once you understand you want to build an empire or build an exit, now you can go out and building your strategy, building out your M&A strategy of what you want to achieve and how you're going to achieve it. That's ultimately what it's about. How are you going to achieve your income goals or your enterprise value and your exit goals? Now, before we get into that, it's really important to understand the different sizes of businesses. Mergers and acquisitions has its classification of the size of businesses, and ultimately governments also do as well. So let's go into the three sizes. The first size is a micro business. They're all businesses, right? So micro business is number one. The number two is small business. And number three is mid-cap, mid-market, or middle market. Let's call it what it is. Okay? Let's talk about micro businesses and small businesses first. Then we'll talk about middle market businesses, because middle market businesses is a very wide range, and that is also divided into three different types. So a micro business, now different people have different definitions of what a business is. I'm going to use revenue as the benchmark for saying what a business is. So a micro business is generally classified as any business with less than 1 million in revenue. So less than 1 million, whether that's dollars, pounds, euros, it doesn't matter. Okay, I'm going to use pounds, obviously I'm British, right? So less than 1 million. Now, actually, what I've found throughout my journey in acquiring businesses is that micro businesses are actually really, in the sense of investors or access to investors and access to lenders, access to capital, is actually any business which is doing less than 2 million in revenue. This is what I have found. Even though people have been telling me all this time, right, when you get to 1 million, then this is going to happen. When you get past 1 million, then this is going to be easier. I didn't find that. When I crossed 1 million in turnover in my business, it got easier. Don't get me wrong. Things got easier because there's a difference, right? If you have a business which is doing 300,000 in revenue, is doing 600,000 in revenue, it's even doing 999,000 in revenue, it doesn't sound as impressive as a business which is doing 1 million. There's something about that number which excites the mind, right? There's something about the million number which excites the mind. And things did get easier. However, it's only when I crossed 2 million in revenue that things started opening up in a much better way. And by the way, 2 million isn't even like the best. We'll get there when we get there. So a micro business is doing anything less than 2 million. If you're going to follow the real advice, meaning, what do I mean by real advice? Because ultimately when you're going to buy businesses, then you need access to capital. You may be a high net worth individual right now. or your business may be of a certain size. But you're not going to dedicate 100% of your capital to these acquisitions. That's not the right thing to do. Okay? You've got big businesses, Apple, Microsoft, they're sitting on loads and loads of cash, but even they have a very small amount, but even they have debt, or they raise money from investors by selling shares on the stock market. So even though you might be a high net worth individual, you're to raise money, and you can raise money after 2 million in revenue. Now, let's get to small businesses. Generally speaking, there's not much of a disparity between people when they're talking about small businesses, except I have made this definition. Some people say 1 million, I'm saying 2 million. Small businesses are any business which is doing 2 million to 10 million in revenue. Now in the UK on Companies House classifies a small business at 10.2 million. I don't know what the 200,000 is there for, it's there, whatever. But it's 10 million. So any business which is doing 2 million to 10 million in revenue is classified as a small business. Now, a lot of people are thinking that, oh, I thought any business which is sort of doing 1 million or less is a small business, and any business which is doing 2 million to 10 million is a large business. It's not. In the real world, in mergers and acquisitions, that is still classified as a small business, 2 million to 10 million in revenue. So whoever's been telling you that is telling you porkies, and you need to ensure that you're getting the right advice. Because when you come to this level, then your business starts becoming interesting. What do I mean by that? So your business, when you've got 2 million to 10 million in revenue coming in, generally speaking, you've got management team, you've got some processes in place, you've got departments within your team, within your business. Now, it may not be large departments with, for example, directors and heads of departments and then managers and then supervisors. It won't be at that level. However, you will have some structure around your business, and that's why you're classified as a small business. The next is middle market. So middle market is divided into 3 separate segments. So let's go into here. So you've got lower mid. I'm just going to write lower mid. Let's just put a line here so there's a clear difference here. And then you've got middle mid. So you've got middle market. So we'll just call it middle mid. And then you've got upper middle market. Upper mid. Okay? Now, there is no hard and fast rule here. There's no hard and fast rule here. Now, I'm going to take a little bit of a minority opinion when it comes down to lower mid, of where the lower mid starts. So, lower mid market, some business brokers, and I'm talking about good business brokers, I'm not talking about those high street guys that don't know what they're talking about. Some business brokers start lower mid at 5 million in revenue up to 25 million in revenue. But you can be like, hold on a second, I thought 5 million in revenue is small. It's a small business. It is. But the lower mid, remember it's lower mid, so it's pulling in from a little bit of the small business side of things. You know, you got business which is doing 5 million in revenue, let's say it's got 10, and really it's about having at least a 10% profit margin in this as well. So if you've got a lower middle market business which is doing 5 million revenue, generally speaking, that will be doing at least 500,000 in profit. And then that's when it starts getting interesting for that. Because, okay, we're not going to get into valuations and multiples, but let's say, for example, you achieve a 4x multiple on a 500,000 revenue profit business, that's a 2 million asking price or a valuation to the business. The business brokers, the corporate advisors, they're going to make a significant fee off that. And that's where it starts getting interesting. So I'm going to take the minority opinion, but if we go by what small business is, then it is generally speaking anything from 10 million to 25 million in revenue. Now, middle market, what is middle market? Middle market is when you've got a business which is doing, and there's some crossover here. So I'm going to say 20 million, even though that says 25, and there's a reason behind it. You're gonna know in a minute. So 20 million in revenue, up to 100 million in revenue. Okay. So why have I made this crossover just like we made it with small business? A business which is doing 20 million in revenue, you start getting some private equity houses start getting interested in businesses which are doing 20 million in revenue. And you'll know that they're getting interested in it because the profitability of that again is about 10%. If, for example, there's some really small private equity houses which are going to be interested in a business acquisition when it gets to about 2 million in profit. Okay, 2 million in profit. It's going to be a few of them, but there are some. Generally speaking, private equity likes 5 million plus, right? And middle market means it's 20 million to 100 million. So you're like, hold on a second, 100 million revenue business is a mid-sized business? No, it's a large business. It's not a large business. It's classified as a middle market business. Okay? Private equity is extremely interested in this. And that's why there's a lot of activity in the mid market and the upper middle market. Let's get into upper middle market. So upper middle market, there's a bit of a difference of opinion. And to be perfectly honest, on the upper side of the middle market, I'm not really involved in that. But from what I know, through reading and literature, it's 100 million. And I've seen 250 million in revenue. And I've also seen 500 million in revenue. I'm going to say 250 million in revenue. And the reason why is because a large privately held business can access a lot of creative finance, a lot of tools past 250 million. Okay, a lot of tools can be accessed when you're past 250 million. The reason why some people say it's 500 million is because you can start listing your business on the stock market. And to be perfectly honest, you can list your business on the stock market from 100 million onwards. But it's going to be on one of the secondary markets. So it won't be on the, for example, the FTSE 100. It won't even be on the FTSE 250 in the UK. That's going to be on the AIM market, right? Which is the secondary markets. So, but when you get to 500 million plus, you know, you can actually get listed on those markets and there'll be people who are interested in buying your stock. So that's a quick introduction on mid-sized business as well. So why do I mention all of this in this M&A masterclass, in this introduction to mergers and acquisition strategy? Anyone who is operating in less than $1 million, now I will say this here. And by the way, I've made acquisitions in less than $1 million as well. These businesses have very, very little capital which is allocated to that. Very little capital is going into businesses which, and what do I mean by very little capital? I mean, they don't have access to cash flow lending. They don't have access to institutional investors. They don't have access to acquisition products and financial products when you're trying to acquire businesses less than $1 million. When you try to acquire a business which is doing at least $1 million in revenue and at least 100,000 in profit, you get some of these low-level investors and low-level lenders which start getting interested in your business. Now, don't get me wrong. That doesn't mean that there's no activity in the micro business, you know, especially sub 1 million market. There is a lot of M&A activity, but your products which are available to you are extremely expensive and they're few and far between. Now, I do know who they are, how you can access those products, but do you really want to have an uphill battle, especially if you're a business owner right now? Now, even if you're a business owner right now and you're doing less than $1 million in revenue yourself, I would strongly advise that your first acquisition is going to be 1 million plus, if not 2 million plus. You can be like, hold on a second, my business is only doing 500,000, 750,000 in revenue. How am I going to go out and buy a business which is doing 2 million in revenue? You can do it. Why? Because products start getting, or you can start accessing products which is going to help you to do an acquisition of 2 million plus. But you have, by the way, you have to be a business owner for that. You can't be an individual. And one thing I just want to highlight here, look, there's probably a lot of guys who are watching this, or girls or whoever, watching this video and they are starting from scratch. They have no business. You know, the amount of people that call me and they say, I want to become an M&A expert. I want to become a, you know, I want to have, I had one guy, he calls me because in 3 years time, I want to have a business which is doing £1 billion pounds in revenue. And I'm making, you know, 20, 30 million in profit. I said, look, I said, do you know anyone who's a high net worth individual? No. Have you got any special contacts? No. What do you do right now? Nothing. I'm unemployed. How are you going to do that? You can't do it, right? So if you're completely starting, you need to stay in your lane a little bit, right? Now that doesn't mean that you can't go out and do a good acquisition, a big acquisition. You need to build a team. You need to have the right infrastructure. It takes time. But I normally speak with individuals who at least has some capital to invest, and especially business owners. I deal with business owners because I know, being a business owner myself, exactly what path we need to take. Right. So there's very little capital which is in the sub 1 million market. There's some capital is available at the 2 million market, right? I should say 1 million to 2 million. There's some capital which is available at 1 million to 2 million. So you can access that. But when it comes down to small business and middle market business, you start getting products which are available, and investors start getting interested for small business to mid market businesses. Okay? Just think about an investor and they want to deploy, for example, they've got $500,000 to invest. You're going to go and ask them, you're going to say, give me 300K. They're going to say, no, I'm not going to give you 100% of the money. You need to go and find you to raise it from somewhere else. And unless they know you, that's different, right? That's different. So let's say, for example, they give you 100K. Now, another person gives you 100K, and let's say you sellerfinance the rest. Okay? What kind of return can they expect? Can they trust you, or can they trust the business, more accurately, to return an investment or give them a return from their investment? What's the likelihood of this small business which is doing 100,000 in profit tanking? What's the likelihood of it being wiped out? It's very high. Yeah? So that's why investors don't like investing in small deals. They like deals which are 2 million plus, 10 million plus, 25 million. Remember, private equities only get involved from mid-market, really. So that's how you need to understand the M&A landscape. This is the M&A landscape. Right, so now let's say we're going to take one, but otherwise this class is going to get too big. Or in fact, we'll do both, but let's focus on income right now. So let's say, for example, you're a business owner right now, you're doing 1.5 million revenue, about 200,000 in profit, and you want to increase your income. You understand that there's micro businesses, there's small businesses, mid-cap businesses. So now you need to decide, what level of income do I want to achieve over a long period of time? And for what period of time do you want to be active in the acquisition market? Now, generally speaking, once you start doing acquisitions, especially once you've done your first acquisition, it's like a drug. You can't stop doing them. Like, you have to do them. So take that from me, is a bit addictive. But let's say, for example, you're doing 200,000 in profit right now. Okay? And let's say 200,000 in profit, let's say you're personally drawing 100,000 for yourself in income. So your current income is 100K. But you got, for example, I don't know, you've got children which are growing up, they want to go to university. You have to sort of think about their weddings and stuff like that and going on nice holidays. And let's say that you want to increase your income to 1 million. Okay, why am I going to say 1 million? It's the magic number, right? People, something clicks in your mind when you say 1 million. I want to achieve 1 million a year in profit. That's what your goal is. By the way, you can achieve a lot more when in mergers and acquisitions. So now you need to decide, right, I've got currently 200,000. And by the way, when I say 1 million profit, actually, let me say that you would have 1 million in income. In personal income. Let's change that. Because that's what it's all about, right? Now, let's just use a taxation of 50% to make the numbers easy. That means you have to be able to draw down on 2 million of profit. Okay? You have to be able to draw down on 2 million in profit from your business. How are you going to achieve that? And let's say, for example, you don't mind waiting a little bit. So this is a longer term goal. You want to achieve that in 10 years time, for argument's sake. Yeah? Let's just put a 10 year. Right. Another thing. You've got short-term goals, you've got medium-term goals, and then you've got long-term goals, right? You have to have different goals. You can't say, like that guy, I want to achieve, 20 million, 30 million in the next 3 years. That's ridiculous. That's a short to medium-term goal. He's trying to put a long-term goal to a short to medium-term goal. It just doesn't work. Okay, so you have to get that. You have to be realistic, firstly. That doesn't mean that you don't go 10x, like Grant Cardone says, right? Go 10x. You can go 10x, that's perfectly fine. But you have to also be realistic as to what's available in your marketplace, what marketplace that you have, or what industry do you have, and how active you want to be. Now, for example, you got people currently right now in the, you see them, Grant Cardone, you got Alex Hormozy. These guys are super active. They wake up 5 in the morning, they're at it all day, bam, 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 bam. Do you want to work that hard? And if you do, great. Me personally, I don't. And I don't, right? I'm a lazy guy, basically. If you compare me to Grant Cardone, Alex Hormozy, all of these guys. So you also have to think about the activity levels that you need. Now, one good thing about mergers and acquisitions, and probably accidentally realizing afterwards, is that you don't have to work super hard to achieve a lot. Okay, that's one of the best things about mergers and acquisitions, especially if you set it up correctly. So coming back here, you need to achieve 2 million in profit. Now, you have a business, have a good business mind. Yeah, have a good business mind. If you need to draw down of 2 million of profit from your business, you can't have a 2 million profit business. Yes? You probably want to have a 3 million profit business. Why? Because there's something called working capital. So you want to achieve a 3 million profit business in 10 years. Now, by the way, you can achieve a 3 million profit business in 5 years with mergers and acquisitions. Sometimes even quicker than that, depending on your industry and what access you have to tools and capital. Now, a 3 million profit business, let's say for example, the average business in your industry, which is operating on the upper side of the market, is generating, for example, let's make the numbers easy, 300,000 in profit. Okay, 300k in profit is the average business. Profit, average business. What is there? Now, it doesn't take a rocket scientist to realize that you need to make 10 acquisitions to achieve 3 million in profit. Okay, so let's say for example you need to do 10 acquisitions, yeah, to achieve your goal of 3 million. Now, let's say it takes you 5 years to do those acquisitions. Look, I'm a big believer of taking it slowly but doing the right acquisitions. My methodology of doing acquisitions, I call it the value acquisition system. The purpose of the value acquisition system is to make sure that you do the right type of acquisitions and not any acquisition, right? Because you can go out and buy any business that you want, but you can end up buying crappy businesses, and you don't want to buy crappy businesses. Yes? I bought one crappy business and it's a headache, yeah, and it doesn't return me the investment that I want or the ROI that I want. Look, mergers and acquisitions or acquisitions is an alternative investment class. If you're going to look at it from the investment perspective, an alternative investment needs to return you about double of what the market's going to return you. Okay? So the market would return you about 7% on average per annum. So that means that your alternative investment needs to return you, let's make the numbers easy, at least 15%. Now, me personally, I only work on a ROI of 20% or more. Yeah? So when I go into an acquisition, I look at a particular acquisition, I'm like, okay, is this business going to achieve a 20% ROI or more per annum? And if it is, then I'm interested, and if it doesn't, then I'm not interested. Now, the one business that I bought returns me 10% return on investment, so therefore it's a failure in the sense of a acquisition perspective. Now, it's not a failure because it does give me an ROI. Coming back here, yeah? So, let's say for example you do 10 acquisitions, I'm going to put the S there, to achieve 3 million in profit, and you want to do that over 5 years time. Why did I say about slow acquisitions? Do the right acquisition, do them slowly. Do it over 5 years, which means you're going to achieve 2 acquisitions per year. Yeah, that's if you average it out equally. But you can do 3 acquisitions, you can complete it in 3 years. You can do 4 acquisitions. Now, by the way, I don't recommend anyone does more than 4 acquisitions in a year. That should be the limit. If you want to, unless you've got a large team which is doing integration, that's fine. You can do 10, 15, 20 acquisitions per year because you've got a team which is dedicated to integration. But when you're starting out, you don't have a team dedicated to integration. In fact, you're building your team just to get an acquisition done. Forget about the integration team, okay? So let's just keep it at, let's keep it at 3 because 2 acquisitions per year is a little bit less. Oh, you know what? Let's do 2 acquisitions, it's fine. 2 acquisitions per year, you can easily do, let's say you don't want to work high activity, you want to have a relaxed acquisition thing, you want to carry on in your business and not have too much stress, or when I say too much stress, but no like immense amount of stress, and you want to do the acquisitions. 2 acquisitions per year, you can do the acquisition, you can have a fantastic integration time as well, you can ensure that your businesses are running and you can dedicate the time and have a lot of free time as well. So do 2 acquisitions per year, 300k per business, and that's when you can achieve your 3 million in profit. Now, one thing I will say is that when you're going out to buy businesses, if you're using debt, now also investors, by the way, because there's 2 types of investors, and we'll get to that when we're doing the investment masterclass, right? But you've got investors who are going to provide you debt, or there's investors who want equity in your deal. If you, for example, have debt, whether that's raised by investors or whether that's raised via lenders, meaning actual institutional lenders, obviously you have to pay them back. You have to pay investors back as well, yeah? So if you've got 3 million in profit business now, if you work on the same basis as me, that you want to have at least 20% ROI, that means that your debt service coverage ratio has to be at least 2 times, right? Now, or your debt needs to be paid off in 5 years. In 5 years, right? So you've got 3 million profit that you achieve. Your actual business is throwing off 1.5 million in free cash flow. Okay, I should put free cash flow there, yeah? So your business is throwing off a free cash flow of 1.5 million. And that will happen over a 5-year period. And that's why I said, now this is quite important as well. Generally speaking, I say you want to keep working capital in your business. Okay, so you got 1 million in personal income, you got 1.5 million, which is achieved because of your debt service coverage ratio. And we're not going to cover debt service coverage ratio in detail right here. But let's say, for example, you got year 1, you got year 2, year 3, year 4, and year 5. Okay, in year 1, you do 2 acquisitions at 300,000 each. You've got 600 in profit. I'm going to leave your 200 that you got from your business aside here. That's your business, 200,000 that you're getting, you have from your business, but you've achieved or you've acquired 600,000 in profit. Your free cash flow, assuming a debt service coverage ratio of 2 times, is 300,000. Okay. I'm going to call it FCF. Yeah, FCF, free cash flow of 300,000. Year 2, you buy another 2 businesses at 300,000. Now your profit is 1.2 million and your free cash flow is 600,000. Free cash flow. Okay? Free cash flow of 600,000. And that doubles, but year 3, you add another 600,000. So now you've got 1.8 million in profit and you've got 900,000 in free cash flow. Excuse me. And then year 4, you have 2.1 million in revenue. 2.1 million in revenue. And you have, let's say 1 million, 1.05, but it's quite 1 million in free cash flow. And then year 5, you have 2.2, that's not right, 6.2, 1.8, 2.4. Here you've got 2.4 million in free cash flow, and here you've got 1.2 million, and then here you have 3 million. You've got 3 million in profit, and you've got 1.5 million in free cash flow. That's better. Right. So year 5, you've achieved your profit number. Remember, you need 3 million profit business to achieve 1 million in personal income. So you got your 3 million in profit there, but your free cash flow is only 1.5 million. So you can't draw on 100% of that 3 million in year 5 to achieve your 1 million in personal income number, because your free cash flow is only 1.5 million. So you want to leave working capital in the business. So let's say, for example, you leave 750,000 of working capital, because remember your businesses are getting bigger, so you need more working capital, right? So you can take 750,000, taxation in half, your personal income goes to 300 and whatever it is. You have 375,000 in personal income. Now this is when it starts getting interesting. When you got year 6, okay, the debt that you used to pay this, to buy these year 1 businesses falls off. So even though you've got a 3 million profit business, okay, your free cash flow is going to increase by 300,000. So your free cash flow is going to go 1.8 million. Yeah, because you've added the 300,000 which was being paid off to investors, that was being paid off to lenders. That's now been added to what you can draw, free cash flow. You got working capital, you got free cash flow. Year 7. Okay, shall I use a different color pen? It's a little bit easier to understand that, right? So year 7 is going to be 3 mil profit, okay? But then your free cash flow is going to be 2.1 million. Now, you're getting closer to your number that you can draw down. You're getting closer to your number. So that's why I say you need to have your long-term goals. You know, over a 10-year period, that's when you can achieve your 3 million profit business, in which you can draw 2 million and you have a personal income of 1 million. Now in 10 years, if for example you're building, and by the way, you know, you're not broke if you're earning 300,000. And we haven't even added in what your business is doing right now. You've got 200,000 that you can draw on as well. Say 100,000 for working capital purposes, right? You're not broke if you're earning 600,000 a year. That's 50,000 a month, okay? You're not broke, or let's say for example you're drawing on 300,000 here. You're not broke. You're drawing on 450,000 here. You're not broke. You're drawing on 500,000 here. Well, yeah, say 500,000. You're not broke. You're living a good life, right? So this is how you need to think about building your income over a long period of time when you're developing your M&A strategy. Now this is what we just done for income purposes. Now let's take a look at what you do for exit. Now exit is a kind of a different goal. It's because when you're building for exit, what you're doing is that you're reinvesting your money. Or you should be anyway. Obviously everyone needs to live. But what you do is that you take a smaller income. You're not looking to draw the 1 million personal income unless you can. Of course, if you can, that's great, depending on the size of the businesses that you're buying. If you're buying mid-cap businesses, then you'll be able to do that, or you might be able to do that. But even then, when you're building for exit, you want to reinvest as much as possible into growth. Okay? So you're reinvesting into growth. You're reinvesting your free cash flow into buying more businesses as much as possible. Let's say, for example, during that time, you make an income of 100,000. Okay, you're on 6 figures, you're in the top 5% of income earners. Well, in the UK, you may know the US is an inflated market, so whatever they're top. Take top 5%, yeah? Whatever it is, the bottom of the 5%, become top 5%. Or top 10%, whatever you want, right? Depends how much of a, what do they call those guys? Hermits, right? They're the ones who live in the mountain. But anyway, depends how much of a hermit you are. Now, let's take a look at exit. What we'll do, we'll use 7 years and as an exit, because when you're reinvesting, then you want to try and like shorten the time a little bit. When you're doing empire, then you can go on for 20, 30, 40. Look at Warren Buffett, right? Warren Buffett is 90, whatever years old right now, 94 years old at 5. Let's call him 96 years old. The guy's a multi-billionaire. Anyone who is reinvesting and, you know, building for income or building an empire, they can do it forever. Okay? Now, let's say, for example, you want to achieve an exit of 10 million. Why? 10 million is one of those magical numbers as well. It just clicks in people's mind. By the way, okay, let's not get into that. That's different. Let's say you want to achieve a 10 million exit. Now, what that means is that you need, at the very least, a 3 million profit business. Because what you're thinking, okay, you want to achieve 10 million exit cash on completion. Right? Let's say this. Cash on completion. If you have a business which is doing 4 million in profit, you would have had to be a bad negotiator to not achieve 10 million cash on completion. Get a bad negotiator. Now, let's say for example you got investors. This is interesting. Let's say you got investors. Now they become shareholders in your business. Let's make this, you want to achieve 5 million in profit. 5 million in profit because let's say for example you've raised money from investors and then therefore you've given away 33% of equity. So you own 2/3 of the business and they own 1/3 of the business, for argument's sake. Now, so if you do a 3, 4, 5x multiple, let's say worst case scenario, bad negotiator, you know, a really bad deal, you only got 3x profit at 5 million, then you have to be dumb for that because I don't know what's going on. You need to hire a proper broker. Now, you need to just carry on buying businesses, okay? Just reinvest. As soon as your 1.8 million, 2.1 million becomes available, you invest that into buying more businesses. Buying more businesses. Okay? And also, I mean, when you're looking for an exit, you need to build enterprise value. Okay? Enterprise value. And although profit is the number one factor of enterprise value, there are other factors that can build enterprise value as well. You being an owner investor instead of an owner operator is going to give you more enterprise value. You having a good structured management team which can run the business without you, even though you might be the operator, is going to build enterprise value. Lifetime value of your customer spend is going to build enterprise value. Right now, especially, recurring revenue is going to build enterprise value. So there's so many different factors when it comes down to enterprise value that you can build other than profit. So all you need to do is that instead of drawing as much income as possible, or as much income while keeping the business cash flow healthy, you just reinvest and build, and then you work for that 10 million exit cash on completion. Okay? So that's a little bit of a different strategy when you're building for empire versus when you're building for exit. And the other thing is that when you're building for exit, you're going to try and reduce the time that it takes to exit. So instead of having a 20-year empire plan, you might only want to have a 80-year exit plan. Okay, because what you're doing is you're sacrificing income to essentially bet on that exit. And I don't mean betting as in gambling. I mean, you know, you're doing work, right? So you want to reduce the amount of time it takes for you to achieve that exit as much as possible. Yeah, private equity firms, they normally operate on a 3 to 7 year cycle. Okay, so it's your first, for example, time you're doing it. Let's say you mess up, it takes you 8 years. But ideally, you want to try to stick around this 3 to 7 year fund cycle if you can. So that's a little bit of another thing they need to look at when you're building your M&A strategy. Another thing you need to consider is that you're a business owner or you're an investor right now. So what is your other pathway going to look like? So there's, for example, two types of people. Either they want to be an operator or they want to be an investor. Okay? So you're either an operator or you're an investor. Okay? Now, if you're an operator, you have a slightly easier time. I can tell you that right now. Slightly easier time. And if you're an investor, you have a slightly harder time when it comes down to M&A. And I tell you the reason why. It's because I'm an investor and I have to be a bit more picky about the deals that I'm going to do. But let's put it into context. So let's take a look at the rest of this now. Now, you have, let's say you're an operator and you just want to buy one business. Okay, you want to buy one business. Operator buying one business. You can be a little bit more flexible about the type of business that you're going to buy. And the reason why you can do that is because you are going to go in and you're going to be implementing your strategies. You're going to be driving the business forward. You're going to be at the helm of that business to make it more valuable and to produce more income for yourself. Whereas if an investor is buying this one business, so what do I mean by that? This one business can be, all right, I wouldn't say distress. I'd never say buy a distressed business unless you exactly know what to do to fix it. So this business, for example, can be on the decline over a period of time if you're an operator. And the reason why it can be that is because when you come in, the whole point of you, and then you're going to get a good deal on that business, yes? You're going to get a good deal. You're not going to pay 3 times multiple, 5 times multiple for that business. You might only pay 1 time multiple, 1.5, 2 times multiple for that business, okay? Now, it's not common to get one time multiple, but it's possible when a business is on decline, especially if you're an operator and the thing is right. So then you are going to work to get that onto an up. You're going to increase the revenue. Okay, that's because you're an operator. If you're an investor, how much time do you want to dedicate to your business? Now, an investor, there's no such thing as a true investor when you've only got one business, if it's a small business or below. So obviously you've got micro business and small business. If it's a mid-cap business, then you can be a true investor. Okay? Now, so I'm an investor, and I see a business which is on the decline, I automatically don't want to go for it. Okay? There has to be some really good reason why I want to go for that deal. Yes? So, as an investor, I have a smaller pool of businesses that I want to go for. Because I'm not willing to do the work. Yes? Now, I have a team that can do the work for me now, but not as the first business. That's what I want to just highlight there. So now I have a team of 50 plus employees. I don't know what the exact number is. It's probably coming about 60, 65, something like that. They can, or the executives anyway, not obviously the the juniors, whatever. But the executives, they can work towards, right, how do we improve the business? How can we coach the managers to ensure that they can improve the business? Yes? But if you're buying your first business, your pool of businesses that you can go for is really small. Right? And if you're an investor, let's say for example you're a high net worth individual, or for example you've got, I don't know, you've got 600,000-700,000 that you want to commit to an acquisition, or you've got 200,000-300,000 you want to commit to an acquisition. You're not a high net worth individual, but you've got a significant chunk of cash there. So you don't want to buy a business on the decline. You want to buy a business which is steadily increasing. And you don't mind paying a small premium for that because you know that you can sit back and relax. And the management team who've been running for the last 5, 6, 7 years have been giving it a steady increase over that period of time that they've been in charge. So you're lucky. So that's the first thing. Then you've got the second one. Do you want to be an owner operator and you want to buy multiple businesses in the same industry? Same industry. Yeah, so let's say for example you want to go out and do 10 acquisitions in the same industry. If you're an owner operator, again, those 10 acquisitions, you're going to be driving them forward. You're going to be at the helm. You're going to be at the forefront. You're going to be the general of the army moving that forward. As an investor, you need to be, again, picky as to what type of businesses you're going to buy. And by the way, this is called a roll-up because it's the same industry. Yeah? Same industry. It's called a roll-up. What's it called? A roll-up. When you're buying one business, it's just an acquisition. There's no roll-up or whatever. Then you've got, and this is also called a roll-up, by the way. So you've got same sector. And that's also called a roll-up. It's also called a roll-up. So you want to buy 10 acquisitions in the same sector. What's the difference between a sector and the industry? A sector is a larger segment of the marketplace, when industry is a small segment of the marketplace. Let's for example use law. So law is a sector, right? And within law you've got commercial law, you've got immigration law, you've got property conveyancing, you've got family law, you've got inheritance law. All of these different, they're sectors, okay? They're industries within the sector of law. And then you have sub-industries, and so that's a different story. That's when you're doing, for example, you're doing family law, but only for divorces, for argument's sake. Yeah. So you're only ever dealing with divorce cases. So that's a sub-industry of an industry. So that's also called a roll-up. So let's say, for example, here you're only doing family law in the same industry, but here you're doing family law, you're doing commercial law, you're doing immigration law, you're doing property conveyancing, you're doing all sorts of things. Okay, so that's a roll up. And then your last one is a conglomerate. So a conglomerate is basically multiple sectors. I'm going to put that here. Conglomerate. Yeah, that's multiple sectors. Now, it's a little bit difficult to be an investor when you're a conglomerate. You have to be of a very big size if you want to be a true investor. And really and truly, I don't think I've ever seen true owner investors in conglomerates. They've normally been members of the advisory board at the very least. And that's fine. I mean, to be honest, I'm part of the advisory board of my business. And it's, pretty rosy, put it that way. But conglomerates, because there's multiple sectors, you need to have specialists in certain sectors, right? So they need to know the sector of law, they need to know the sector of accounting, they need to know, I'm saying if you're rolling up law firms and rolling up accounting firms and rolling up, online businesses and rolling up oil and gas, for argument's sake, yeah, you need CEOs who understand that, CEO for each one of those. And then sometimes, for example, you need CEOs for each industry as well. And that's perfectly fine, by the way. That's multiple layers. So conglomerate is a little bit more tricky on the type of strategy that you want to apply. And you never want to go for conglomerate on your first few deals, okay? So my number one is, get your first acquisition done. Then roll up in the same industry. At least, very, very least 5 acquisitions, ideally 10. 5 is like the baseline, and still you don't want to go into different sectors or different industries. And then once you've done multiple within the same industry, then you can go and roll up in the same sector. Then, if you want to, then you can go conglomerate thereafter. That's when you step up into the different leagues. Yeah. So, for example, in the UK, when you look at the most wealthy people in the UK, it's what's it called, the top 100 rich list or something like that. A lot of the top guys, they've got conglomerates. Okay, now not all of them. Now, by the way, you can be specialized in one industry and have one business. And look at Amazon. Yeah, Jeff Bezos, he has he's got a few businesses now, but he had one business and made it on that list with one business. Yes, a lot of the people, they had one business and they made it on that business. So stay in the industry. By the way, when you stay in one industry, it makes your life so much easier because the team that you have become very proficient in managing that industry for you. So then therefore you become a true owner investor. And again, even if you're an owner operator, you don't want to be working 120 hours a week. Yeah? If you do, good on you, carry on. But I don't. Yeah. So you don't want to be working 120 hours a week. Some people want to work 80 hours a week. Some people want to work 60 hours a week. Some people want to work 40 hours a week. And by the way, as an owner operator, you should always target that you're maximum working 40 hours a week. So even as an owner operator, maximum you want to work is 40 hours a week. As an owner investor, so I do oversee my businesses, and I do between 15 and 20 hours a week. Okay, 15, 20 hours a week. Sometimes 10. Like in this month, I'm going to be doing about 10 hours a week. 10 to 15, something like that. Okay, I'm more than happy doing that because you have to keep your brain active. You have to be involved in the M&A strategies and all of that kind of stuff. So this is another thing that you need to think about within your M&A strategy. All right, one final thing that you need to think about when you're developing your M&A strategy is, can you identify and attract the right size of investor? Now, what does that mean? Is that when you have investors, then they are at different levels and different grades. A lot of people, they go to their friends and family. Their friends and family have only got, 5K, 10K. If they're lucky, they've got 50K that they're willing to invest in a deal. How many 5Ks and 10Ks will you need to raise to go and buy a business which is doing $500,000, or the valuation of that is $500,000 for your first deal? It's a lot, yeah? You have to raise 10 at 50K. How many people in your family have 50K sitting there that they're willing to invest? Now, by the way, you'll be surprised. There's more than you think. But how many are willing to give you money? That's the other question, yeah? So really, what you need to do is that you need to think about, and fundraising is a full-time job. Fundraising is a full-time job. So when you're going out and you're fundraising, you really need to try to build relationships. Okay, and this is really important. It's about build relationships. And depending on, a lot of people when they're watching me, they're only going for, ethical finance, which means mainly investors really. That's investors. But if you're going to lenders and so on, then that's your game as well, right? So you need to build relationships with lenders and investors. And they're different types, and you need to talk to them. Say, right, what size of deals or what industries are you interested in? Okay. A lot of people, they have what do they call it? It's not a lending limit. They call it basically they have a sweet spot. Okay, I can't remember what the term is now. Like for example, I was talking to an investor last week. We've got a meeting booked in January, next month basically. And their ideal lending spot is 750k to 7.5 million. Okay, 7.5. That's what they like. That's their sweet spot. They like to do deals which are from 750k to 7.5 million. If, for example, I was looking at, there was a lender site that I went on because I was just checking it out, and their minimum is 1 million. Okay, so if you're, and that means loan size. Loan size. So this investor is 750k to 7.5 million. And their minimum criteria is that your business has to be doing at least 250k in profit, 2 million plus in revenue, and a certain team size, which our business meets all of that criteria plus more. So this other people, they're minimum 1 million loan size. Now this is interesting because if they're only going to do 70% what's called LTV, loan to value, which means that the business, my math is a little bit rubbish, but the deal size needs to be at least 1.3 million for them to be interested in even lending to you. Okay, so there's different sizes of investors. There's some investors. So I remember a couple of years ago I was talking to an investor. Their minimum, so your business has to be doing 600,000 in EBITDA, 600k in EBITDA, right? And then they're willing to basically give you checks on a line of credit of £1 million a piece, £1 million plus a piece. Okay, but your business is to be doing at least 600k in EBITDA. So they're willing to go to, I can't remember exactly what it was now. I think they're willing to go to 100 million in credit. For the right businesses, of course. They're not going to give, if you're doing 600k in EBITDA, they're going to give you 100 million. That's ridiculous. So they're going to look at your business and say, right, let's say for example you've done 5 acquisitions, then you've done another 10 acquisitions, then you've done another 20 acquisitions, and that's when you're going to reach your 100 million credit, your investment level, then that's fine. Okay, that's when they will do the 100 million. So that's why you really need to look at the size of investors and build that into your path, into your M&A strategy. And you need to understand your industry. You need to understand your sector. You need to understand your industry. What kind of businesses are there? And never go for the smallest business in your industry. Always do the biggest deal that you can do. Even if it's your first deal, try and stretch your target as much as possible. The more you stretch, the better it will be for you, both in terms of the income that you can take from it, the value that you create from it, and the type of investors that are going to be interested in funding those deals. So that's a quick summary of M&A strategy. Remember, the first thing, the things that you need to look at is size of business. Size of business. Is it a micro business? Is it a small business? Is it a mid-cap business? Then you need to look at what your goal is. Yeah, or in fact, whichever way around, your goal, is it empire or exit? Then you need to look at what the strategy you're going to use and your pathway. Meaning how many acquisitions over what period of time. And you need to always take into consideration the size of investors and always be fundraising. So I hope that gives you a brief introduction into M&A strategy. And if you want to find out more about mergers and acquisitions, acquiring, building enterprise value, continue watching videos on this channel. And if you want to get in contact, there's links in the description, and my phone number somewhere on this page. Definitely reach out, but only if you're a business owner or if you're an investor with a significant amount of capital that you can deploy. I'm happy to talk to you and talk to you about building your M&A strategy. I'll see you in the next video.